Most people think a crisis begins with panic, a crash, a breaking headline, a red chart. But what if the next silver crisis doesn't start with a fall? What if it starts with an opening? Not a collapse, an opportunity. Not chaos, calm. And that's what makes it dangerous. This is Macro Signal, and today we're uncovering why the real silver crisis may begin quietly, during a moment that feels completely normal. Before we go deeper, take 1 second to like this video and subscribe to Macro Signal, because the signals we about to talk about don't come twice, and they rarely look urgent when they first appear. Here's the illusion. Investors are trained to expect crisis when prices drop. They associate danger with volatility. But in reality, the most important market shifts begin during stability, when nothing looks broken, when prices move smoothly, when confidence feels justified. Silver is entering a phase where calm could be mistaken for safety. But history suggests the opposite. In past cycles, the biggest structural changes began when markets quietly opened new positioning opportunities for those paying attention. The public saw stability. Institutions saw timing. A crisis doesn't always start with loss. Sometimes it begins with access. Access to physical supply, access to favorable pricing, access to reposition before momentum builds. These openings are rarely advertised. They appear during periods when attention is low and urgency is absent. Macro Signal focuses on these early openings because they reveal intent. When large players begin adjusting exposure quietly, it suggests preparation rather than reaction. And preparation always happens before disruption becomes visible. Think about how this works. If a market were truly secure, there would be no need for subtle shifts in positioning. Stability would remove urgency. But when structural fragility exists, even small opportunities are used to strengthen long-term exposure. Right now, silver shows signs of such an opening. Not dramatic, not headline-worthy, but noticeable in behavior. Price stability combined with subtle shifts in supply access and positioning patterns often signals the early phase of change. The danger is psychological. Calm invites delay. Delay creates missed positioning, and missed positioning turns opportunity into crisis later. This is why the next silver crisis may not begin with fear. It may begin with confidence, with a sense that there is still time, with a belief that stability will continue. As we continue, we'll explore what defines an opening, how institutions recognize it, and why these quiet phases often precede the moments everyone remembers. Stay with me, because the beginning of a crisis rarely looks like the end. If a crisis can begin with an opening instead of a crash, the next question becomes clear. What does an opening actually look like? Because it doesn't arrive with noise. It doesn't announce itself. It feels normal. It feels stable. And that's why most people miss it. An opening is not about price spikes or panic demand. It's about timing. It's about when access becomes easier before conditions become tighter. In silver markets, this often appears as availability that still feels comfortable, pricing that seems fair, and sentiment that remains calm. But beneath that surface, behavior begins to change. Macro Signal tracks behavior more than headlines. And historically, when markets approach structural stress, subtle positioning begins before volatility rises. Now, institutions don't wait for confirmation. They move during comfort, not chaos. Right now, silver's stability creates that comfort. Volatility is controlled. Supply appears accessible. Demand looks steady. Nothing screams urgency. But that environment allows preparation. Think of it like doors slowly opening before a storm arrives. Now, the storm doesn't start with the doors. It starts later. But those who notice the opening had time to move inside. In financial markets, preparation often looks like diversification, quiet adjustments, reduced reliance on purely financial assets, increased attention toward tangible value. These moves don't require panic. They require awareness. Silver fits naturally into this phase because of its dual role. It supports industry while also carrying monetary characteristics. That makes it attractive when confidence in purely financial structures begins to soften, even slightly. Another signal of an opening is liquidity that still functions smoothly. During early phases, transactions remain easy. Pricing remains predictable. There's no urgency to secure access, but that ease can change quickly if demand rises or supply tightens. Macro Signal does not assume sudden disruption. Instead, it observes readiness. When readiness increases during calm periods, it suggests underlying caution among larger players, and that's the key insight. A crisis doesn't require immediate stress to begin forming. It only requires preparation to start. Once preparation spreads, the market's foundation shifts quietly. Retail investors often respond later because calm conditions feel safe. There's no visible reason to act, but by the time urgency appears, the opening is already closed. In the next part, we now look at how physical supply and institutional thinking interact during these openings, and why the absence of panic can be more important than its presence. To understand why an opening matters in silver, you have to look beyond price and into physical reality. Silver is not just numbers on a screen. It exists in vaults, supply chains, factories, and inventories. That physical layer behaves very differently from paper markets. During calm periods, paper markets dominate attention. Charts move smoothly. Contracts trade easily. Everything appears balanced. But physical markets tell a quieter story. Availability shifts slowly. Storage patterns change. Long-term holding increases. None of this creates headlines. But together, these changes signal preparation. Macro signal pays attention to these subtle movements because they often appear before volatility returns. When physical supply begins to tighten quietly while price remains stable, it suggests that confidence in easy future access may be declining. Institutions think in terms of access, not just cost. If they believe supply will remain abundant, urgency stays low. But if they sense that future availability may narrow, they begin securing exposure early, not dramatically, gradually. This behavior doesn't push prices immediately. In fact, it often keeps markets calm. Accumulation done carefully avoids disruption. That's why an opening can exist without obvious price movement. Another important element is perception. Markets function on belief as much as reality. As long as participants believe supply will meet demand, stability continues. But once perception shifts, behavior follows quickly. Physical markets move slower than financial sentiment. That lag creates opportunity for those watching carefully. When supply flexibility decreases even slightly, it doesn't trigger panic. It invites preparation. Silver's industrial demand adds another layer. Unlike purely monetary assets, silver consumption is tied to production cycles. This means supply cannot always adjust instantly. When long-term demand intersects with cautious positioning, pressure builds quietly. Macro signal observes this interaction because it has repeated across cycles. Calm periods often mask early preparation for tighter conditions. And once that preparation becomes widespread, the opening begins to close. Retail investors typically wait for confirmation. But confirmation often arrives through volatility, by which time positioning becomes more difficult. That's why the absence of panic is meaningful. When large players prepare without urgency, it suggests foresight rather than reaction. Because when markets become quiet, big players don't relax. They reposition. Right now, hedge funds are not chasing silver higher. They're not piling into momentum trades. Instead, they are slowly shifting exposure, moving capital out of areas that depend on stability and into assets that survive instability. And silver sits exactly in that category. But this is where most retail investors misunderstand what's happening. They expect silver to behave like a trade, something that spikes during panic and falls when calm returns. But historically, silver doesn't move first. It moves when trust breaks. And trust isn't breaking loudly right now, it's breaking silently. The bond market is no longer reacting normally to policy signals. Liquidity injections are producing smaller effects. Interest rate narratives are losing their ability to guide expectations. And yet, volatility remains low, which creates the illusion that control still exists. But control isn't measured by headlines. It's measured by how much effort is required to maintain stability. And today, it's taking more intervention than ever before to keep markets calm. This is why silver isn't exploding higher, because the system hasn't snapped yet. It's stretching. Behind the scenes, balance sheets are becoming more fragile, not because of obvious defaults, but because of structural pressure. Refinancing cycles are tightening, credit quality is quietly deteriorating, and liquidity is becoming selective. Money is still moving, but not freely. And when liquidity becomes selective, confidence begins to fragment. That fragmentation doesn't show up in price immediately. It shows up in behavior. Banks become cautious, funds shorten duration, institutions prefer optionality over yield, and that's exactly what we're seeing now. Silver, in this environment, is not reacting to inflation. It's reacting to the possibility of instability, which hasn't arrived yet, but is being prepared for. Because when markets are truly stable, there's no need to hedge. And right now, hedging demand is rising quietly, not dramatically, but consistently. And that's the difference between a rally and a warning. A rally is loud, a warning is subtle, and silver today feels less like an opportunity and more like insurance. Insurance people buy before they expect trouble, not after. So the real question isn't, why isn't silver moving? The real question is, why are institutions acting like something is coming? And in the next phase, we'll explore what kind of shift could finally turn this quiet preparation into visible movement. And when that visible movement finally begins, it won't look like the beginning of a crisis. It will look like relief. That's the part almost nobody is prepared for, because the silver crisis isn't likely to start with panic. It will start with an opening in policy, an opening in liquidity, an opening that feels supportive, maybe a rate cut that comes earlier than expected, maybe new liquidity programs introduced to stabilize growth, maybe a shift in central bank tone that signals easing ahead, and markets will celebrate. Stocks may rise, bond yields may fall, Risk sentiment could improve. At first glance, everything will look like it's working again. But underneath that relief, something deeper will shift. Because easing doesn't just support growth, it weakens discipline. And when discipline weakens, currency strength quietly erodes. This is the moment silver doesn't spike in fear. It begins to rise in anticipation. Not because the system has failed, but because the system has admitted it needs support. And once support becomes necessary, the long-term trajectory changes. Confidence stops being absolute and becomes conditional. Markets begin to depend on intervention, and dependency is fragile. The moment easing starts, capital begins to ask a different question. Not, is the system stable, but how long can stability be maintained? That shift in thinking is subtle but powerful, because it changes how institutions allocate risk. Instead of chasing returns, they start seeking protection. Instead of maximizing exposure, they diversify resilience. And this is when silver stops behaving like a commodity and starts behaving like a signal that trust is no longer unconditional. At first, the move will look technical, a breakout here, a steady climb there. Commentators may attribute it to inflation expectations or industrial demand. But beneath those explanations lies a deeper truth. Silver will be moving because confidence has changed form. Not disappeared, just weakened. And once that process begins, it rarely reverses quickly, because rebuilding trust takes far longer than losing it. And that's why the silver crisis won't begin with chaos. It will begin with acceptance. Acceptance that the system needs support. Acceptance that stability must be managed. Acceptance that intervention is permanent. And in that new reality, assets that exist outside the system begin to matter more. Gradually, quietly, relentlessly. So if silver begins to rise, while everything else looks calm, it won't be a contradiction. It will be confirmation. Confirmation that the foundation of stability is no longer organic, but engineered. And engineered stability always comes with a cost. Before we wrap up, I want to hear from you. Do you think the next major shift in silver will come from panic or from policy? Drop your thoughts in the comments below. And if this perspective gave you a new way to see what's happening beneath the surface, share this video with someone who still believes calm markets mean safety. Because sometimes the most dangerous moment isn't the crash, it's the opening that comes before it.